One of the principles that I live by and that I teach and talk to anyone that will listen to me is this principle about complexity and complication, and how we humans love to create just an incredible amount of complexity. And when we start to notice that we're doing it, meaning we're creating it, it's coming from us, we're able to stop creating the complexity, eliminate the complexity, and what we're left with is kind of the natural order of things, which in the world of growing money grows your money much better. So in this week's market situation report, what I want to talk about is how there's this natural reversion to mean. And what I mean is, or what I mean, no pun intended, when I say revert to the mean is there's these historic ratios, right? So companies can only be so profitable. And if they get too profitable, then other companies will come in and say, wow, I'll start doing the same business that business is doing. And so profits revert to the mean. And so let's say historically the average profit margin for a certain sector is 20%. If a company comes out and is having a profit margin of 50%, they will only be able to get away with that for so long until other companies in that sector start moving into their territory and lowering that other person's margin so that profit gets back to that historic mean. So the question is, how can you use this historic reversion to mean to your advantage? And by using it, how can you decrease complexity? So the first thing is to notice that everything in the investment world, and I'm pretty close to everything, I mean maybe there's one or two small outliers, but everything in the investment world reverts to its mean. So if something gets way out of whack or completely breaks out of its mean by many standard deviations, then there's an opportunity there for you to make money or not lose money. Now, the first thing I just want to point out is the 10-year Treasury yield. Now, why I want to start with this is because the reversion to mean for the 10-year Treasury yield is that it goes up for 30 years and then it goes down for 30 years. And then it goes up for 30 years and then it goes down for 30 years. So we just happen to be at the bottom of one of those major cycles. And the reversion to mean in this specific case is that the mean is that this trends up for 30 years and this trends down for 30 years, it being the yield on the 10-year Treasury. And the 10-year Treasury put its low in 13 to 14 months ago, which means for the next 3 decades, we're going to have interest rates that are going to be going up. Not hyperinflation or crazy stuff necessarily, but just a long, steady increase in interest rates over the next 3 decades. And so you want to understand how investments revert to their mean because you can take advantage of that. So this is one example where the reversion of this 30-year cycle will continue to happen for the rest of our lives, and it will turn down in probably about in about 2042. So in about 2042, we will probably be at a 15% yield, and then for the next 30 years after that, from 2072, it will be lowering. Now, one of the ways that I look at reversion to means is by using something that I designed called the X-ray, whether it's the sector X-ray or the market X-ray. And what you see on the screen here is a grouping of 5 what are called investment sliders. And all 5 of these are sectors. You have the retail sector, the pharmaceutical sector, the healthcare sector, the REIT sector, and the precious metal sector. And if you look at each one of those sliders, you can see that there's a minimum and a maximum. And then in between there somewhere, there's something called typical, which is the mean, the average ratio, the average relationship between, say, the retail sector and the S&P 500. So as you look at retail, you can see that retail has greatly outperformed the general stock market because the red little box is way over to the right and it's moving back. And as you move down, you can see pharmaceuticals have underperformed the stock market, but now they want to catch up and get back to its historic average and maybe even surpass it. So that means pharmaceuticals are probably a good place to have your money today because they've underperformed and they want to get back to that historic ratio. Healthcare has outperformed the overall market. You can see because the red box is to the right I'm right here, is to the right of the typical range and it's moving back. REITs have outperformed and they're now moving back within the typical range, so you probably don't want to be in REITs. But what you have down here is precious metals. And I want to bring up precious metals because they have greatly underperformed the stock market for the last 2 years. And they're very far beneath its historic ratio with the stock market. And you can see how much space there is to the right of its typical ratio that it can explode past it. And so knowing what these ratios are, which I call them x-rays, but knowing what they are and where they are and which direction they're moving, that can help you find where to put your money. Because the historic ratio of precious metal mining stocks to the stock market is right here, way to the right of where they are today. And there's a huge amount of space over here where they can run. This means that from a historic point of view, the reversion to mean is precious metal mining stocks, which have underperformed the stock market for 2 years, are many standard deviations away from its historic ratio, and they now want to catch up and get back to that historic ratio and surpass it. And that's why you wanting to know what certain sectors' mean reversion numbers are, or just understanding this whole idea of mean reversion, can greatly help you protect and grow your money without complexity and without complication. Now here's just a quick screenshot which I showed last week showing the precious metal mining stocks over the last 2 years and how they bottomed 2 months ago, and they still need to get above this resistance point right here. But there's a lot of fall, there's a lot of loss here of 67% from the end of August 2011 to the end of June 2013. That's about a 67% fall. During that time period, the S&P 500 went up about 30%. So that's about 100 percentage points difference. So precious metal mining stocks will revert to their mean, and that's not a prediction, that's not using crystal ball, that's saying of the 300 years of investment history, all things investments revert to their mean. Now here's the key to having you understand and how to leverage sectors and investments and asset classes reverting to their means. And one of the keys here is getting the time frame right. And if you look at the screen here, this shows you 4 time frames. I have one of them circled, but this first time frame is a 1-year time frame. And what that's showing you, what that shows you is what stocks and bonds and a blend of stocks and bonds can do over any 1 year. And as you can see, of any 1 year, stocks can go up as much as 51% a year, and they can fall by as much as negative 37%. Bonds can go up as much as 43% in 1 year, down as much as negative 8%, and a blend of them. And then you get to this 5-year rolling. And if you've heard me speak for any amount of time or followed me for any amount of time, you know that my magic time is really that 3 to 5 year segment. Knowing what you're going to do over a 5-year period, having strategies that can adapt to make sure that that 5 years works. And so one of my strategies has people owning precious metals. And the last 2 years has been painful, and that last 2 years within a 5-year time block will almost get erased away when we zoom back and look at that 5-year period. But notice what happens when you start measuring or having a strategy that grows your money over any 5-year period. And that is your upside for stocks per year can be 28%, downside only being 2%. Bonds can be upward of 23% a year, downward of 2%. And a blend, it's positive over that time period. If you go out 10 years, and I didn't circle 10 years, but it's to the right of the red circle, you can see that the rates and the returns are lower. And then if you go out 20 years, the rates don't have a losing year. But here's what's lost in all 4 of these. Nowhere in here is inflation adjusted. And so what happens over a 20-year rolling period, inflation eats away at your returns. And so what ends up happening is looking to have a strategy that protects and grow your money over any 5-year chunk of time is the one that's going to grow your money the best. This is not complicated. Knowing how reversion to mean can grow and protect your money is not complicated. Being able to find the sectors that are many standard deviations outside of their historic ratio to the stock market is not complicated. You just go onto the club site and you have all the investment sliders and market x-rays that you can look at. The point of me pointing this all out to you this week is two things. One, how are you making your investments complicated? How are you complicating your investment life? That's two. That's one. And the second thing is, let the natural order of things, this mean reversion, just let it help you grow your money. And the way you can do that is by following strategies, picking strategies that take that into account and that have their time frame in these 5-year chunks of time. And that way, you can grow your money very effectively without complexity or complication over those 5-year chunks of time. So my final thought is your investment approach based on buying strategies or stocks? And how can being diversified into strategies and not sectors or stocks better protect your money? You guys have a great weekend, and I look forward to speaking with you soon. You guys take care.